Welcome to the Wyoming Women's Business Center's 2020 webinar series. Today's presentation is 10 best tax planning tips for 2020. I'm Christine Langley with the Wyoming Women's Business Center, and I'll be your speaker today. You'll notice the Go-To control panel on the right-hand side of your screen for Go-To Webinar. And I just want to call quick attention to the questions panel. If you have any comments or questions during the webinar today, I want you to use those to communicate with me, because everybody on this call is muted to minimize background noise. So immediately following this presentation, a survey is going to launch, and we ask that you complete the survey because it provides us, as well as our funding partners, with valuable information. So once again, if you have any questions during the presentation, just type them into that questions panel, and then I'm going to save some time at the end so that you can ask me some questions as well as the expert that we have on our call today. All right, so we're going to get started with some quick information about the Wyoming Women's Business Center, and then we'll dive into our topic and finish up with the Q&A at the end. This is our 30-minute format, and so we appreciate everyone joining us today during what might be your lunch break. So the Women's Business Center is a nonprofit organization whose mission is to enable and empower Wyoming entrepreneurs, with a special emphasis on women who are economically or socially disadvantaged. And we do that through 4 distinct programs. So the first is our business training and counseling program, which is always free. The second is our microfinance programs, where we offer microloans and individual development accounts. The third is an artist development center. We run that in conjunction with our Works of Wyoming store and our Art Connect gallery in downtown Laramie. And then lastly, we recently launched our COVID-19 support program. So if you want additional information on any of these programs, you can find them on our website at wyomingwomen.org. Now, this particular webinar today is brought to you by the Microfinance Department, and I want to call special attention to our microloan program. We can provide loans for those unable to get loans through traditional means for up to $50,000. And so again, if you'd like more information on that, you can contact our office. So I want to start out today by introducing Derek Campbell. He's a CPA, the manager and founder of Capital Clarity Company in Laramie, Wyoming. Derek was born and raised in Laramie. He comes from a family of entrepreneurs, and that's really where he developed his passion for small business and entrepreneurship. So he's a UW graduate, has a CPA license in both Wyoming and Texas. So welcome, Derek. Thanks for being on our call today.
Thanks, Christine. I'm excited to be here.
All right, so I'm going to have Derek pop in and answer some questions and take some of this information as we go through. But I want to start out with our number 1 tip, which is bank account reconciliation. Now, account reconciliation is the process of matching transactions against your bank or credit card statements. And what I typically recommend is that this review be done at least once a month when you receive your statements. And if you're behind for 2020, now is definitely the time to get caught up. So pull out all those bank statements and start matching the transactions against your register, whether it be inside an accounting software like QuickBooks or a manual ledger that you keep for your business. And you're going to want to do the same for any of your business credit card accounts. So this process can be done fairly quickly if you are already connected between your online bank accounts and QuickBooks Online, and you perform kind of regular upkeep throughout the month. And so I just want you to remember that it's important to learn how to use the undeposited funds account in QuickBooks so that transactions match what's recorded on your bank and credit card statements. So just real quick, I'm going to launch a poll just to find out sort of where everybody is at with reconciliations. So up on the screen, you're going to see a poll that says, how often do you reconcile your business accounts? And so just select the one that makes sense to you. Is it weekly, monthly, quarterly, annually, because you have to file taxes? When are you doing your reconciliation? So I'm just going to give everybody a couple of more seconds to respond. Thanks so much. Again, this is totally confidential. No one's going to be able to see what your responses are. It's just to give me a gauge of sort of where everybody is at. All right, we'll go ahead and close that out. Let's take a look at the results. And we're pretty split here. Looks like we've got 8% that do it weekly, and then pretty even between monthly, quarterly, and annually. All right, so for those that are doing it quarterly and annually, I'd like you to just consider doing it a little more often than that, and hopefully at least monthly. All right, guys, tip number 2. Let's talk about reviewing your profit and loss statement. This can also be called your income statement. So first things first, I don't want you to be intimidated by your P&L statement. And just remember that a profit and loss is really just simply trying to look at your sales minus your costs. Of course, it can get more complicated from there depending on the detail that you enter. But when you're looking at your profit and loss, it usually is going to list your sales, revenue, or income right first. So that's all the money that your business made. And then costs and expenses next. What it costs your business basically to make that money. And then it'll end with your profit, or better known as net income. So you're going to see many subtotals throughout this document, but you're ultimately looking for that profit number at the bottom, or in this example, it's called net income. So depending on the details of your business, these categories can be broken out in different ways. So for example, you might reference different sources of revenue in your business that generates revenue through different means, like in-store sales versus online sales, right? So think of this as the top line of your profit and loss statement. You're also going to probably break out your expenses, like overhead and then materials. Usually you're going to see your costs broken out based on the cost of delivering your product or service in your business, and that's called COGS, COGS. And the general operating costs of the business, that'll be next. So people usually start looking at revenue minus COGS to get their gross margin. And this gives you an idea of how much you then have left over to cover the other expenses after you've covered the cost of producing your product or service. So in this example that you see on the screen, the total income was $6,259. With COGS at $1,750, which makes the gross profit $4,509. Then the other expenses get subtracted from the business that totaled $2,808.47. Then next, your net profit, your net income, net earnings, whatever you want to call it, it's your bottom line. This shows your business's profit or loss. So if you show a loss, it means you spent more than you earned. If you show a profit, it means you made more than you spent. In this case, this business made $2,200.53. Again, if you're using an accounting software program, you should be able to run a report for your profit and loss statement. And the review will be to ensure that your income and your expenses are entered correctly and that they're categorized correctly. So you want to go through your profit and loss statement line by line for accuracy to make sure you didn't make any mistakes. Derek, do you have anything to add on profit and loss statements?
Yeah, that's a pretty good overview. I just have a couple. Be cautious when you're categorizing to accounts such as other business expenses or miscellaneous. From a tax preparation perspective, the idea here is to give the IRS enough detail that they have a good understanding of where your expenses are coming from. Again, we don't want to provide too much detail, and there are many standard accounts the IRS provides on their tax forms, but other accounts that aren't included on the tax forms can always be added by attaching a schedule to the tax return itself. So we don't want to see large balances in miscellaneous or an account called other business expenses, things like that. Let's see what else. I've also seen a lot of interesting accounts created by my clients. I would say more detail is better than less here. Your tax preparer can always group certain accounts together when reporting for the tax return, but they will probably not be as happy with you if they have to go through and break out large balances in accounts that don't provide enough detail. Let's see. The only other advice maybe I would give is keep in mind that these categories or buckets are intended to help you get an idea of how your business is performing. So structure them in a way that makes most sense to your business and not necessarily just from an income tax perspective. right? We can always make adjustments when reporting for income tax, but you want your profit and loss to show you the detail you need to make sound business decisions.
All right, excellent. Thank you. All right, tip number 3, guys, let's drill down a little more on capturing expenses because this is really key for tax preparation. So do you purchase things for your business using your personal Amazon account or personal credit cards? Have you ever used your family PayPal account, for example, to like easily subscribe for a business service? So even if you use your personal funds for business expenses, those expenses are still legitimate tax deductions. The issue there is really keeping track of it, and you want to be careful because you could overlook them since they're not included on your business bank or your business credit card statements. So that's why really scanning your personal expenses for business purchases is part of our top 10 list. So how do you capture these expenses? Well, you want to review your personal account activity for the previous year and then isolate any business expenses you find in them. So if you act before the end of the tax year, then you can write yourself, say, a reimbursement check from your business bank account and then capture the expenses that way. Often, though, there's expenses you may not remember until after the beginning of the new year. And so in that case, you want to enter the expenses into your bookkeeping by debiting the appropriate expense account and crediting an equity account. Now, if I just talked over your head and if that's confusing you, then I just want you to add a note with your business tax prep paperwork asking your accountant or your tax preparer to add those expenses. And then just a quick note here to remember to update those mileage logs. It can add up to a sizable deduction on your taxes. So this is your opportunity to get those updated and accurate before the end of the year. All right, guys, tip number 4, just as you may purchase things for your business using your personal accounts, you might occasionally grab your business credit card on accident instead of your personal credit card when you're in a rush, maybe at the grocery store checkout line or somewhere else. So any of these personal expenses that need to be recorded properly in your bookkeeping system, you want to flag so that they're not improperly deducted as a business expense. So now that we've talked about kind of the difference between business and personal and finding those, I want to launch just a quick poll and see where everybody is at on this call. Just tell me if this is true or false for you. I always keep my personal and business expenses separate, true or false. Again, no judgment here, just trying to understand where you're at and where there might be some growth. Give you a couple more seconds to answer. Thanks for the participation. All right, let's take a look. Okay, so almost 80% of us is keeping it separate, and 20%, that's an area for growth and somewhere we can work on. Good job. All right, we're going to roll on to our next tip, which is around meal expenses. And the Tax Cuts and Jobs Act changed the deductibility of meals and entertainment. So I'm actually going to turn this slide over to Derek and let him explain the changes. Take it away, Derek.
Yeah, so Tax Cuts and Jobs Act went into effect a couple of years ago now. And it did, just like Christine said, it did have a pretty big impact on meals and entertainment expenses and their deductibility. One of the major changes here is, as a general rule, all meals with customers, clients, and employees are only 50% deductible now, and that includes meals during business travel. So you're looking at 50% deductibility on pretty much all of those expenses moving forward. There's also no deduction allowed for any sort of business-related entertainment expenses. Previously that was also under that 50% umbrella there, but now Tax Cuts and Jobs Act eliminated business-related entertainment altogether. So, if there are certain expenses that include an entertainment portion, maybe you're taking clients or customers to a show or other sort of entertainment like that, you just need to be sure that the food or beverage portion of that expense is separately stated on the invoice. And then that makes it, the food and beverage portion at least, 50% deductible. The entertainment, you're never going to get into to a deduction piece for business. I also have a couple other tips that I thought I'd share here. There's some other options, you know. So if you, let's say, for instance, there's a law firm and they are, you know, throwing a promotion to bring potential clients into the new firm. And with that promotion, they have a buffet table or buffet line. I would consider that advertising. You know, that's more for the production of income than it is, you know, as a meal provided to clients. A lot of business owners are providing small snacks or coffee, things like that in the office. Those are pretty much office supplies. I don't know if I would categorize those as meals and entertainment. The last piece I have is office parties and picnics. So anytime you have an office party for the benefit of your employees and their spouses, that brings that into a different category, and that makes that entirely deductible. Okay, so that doesn't fall under this 50% rule for meals and entertainment. It actually makes the entire expense of that event deductible. Now, if you're bringing clients or customers and things into that event as well, the portion of the meal that is provided to your customers or clients, that falls into the realm of 50% deductible. So keep those in mind, you know, as you're categorizing your expenses. If you do push everything into an account called meals and entertainment on your profit and loss statement, your tax preparer will probably only deduct 50% of that. So be mindful as you're categorizing those transactions.
All right, good tip. So gathering 1099s, there's a new form, and so I'm also going to let Derek go over this and the new forms in the next couple slides. So go right ahead, Derek. It's all about 1099s.
Thank you. Yeah, so Christine mentioned there's a little bit of change here. There's this new form. Previously, 1099s to non-corporate service providers were reported on Form 1099 miscellaneous. The IRS has created a new form this year for tax year 2020. The form is 1099 NEC, non-employee compensation. A little background on 1099s for those of you that aren't familiar. I like to think of 1099s as the tattletale documents that the IRS uses to ensure that taxpayers are reporting all of their income. So if your business is service-based, you will likely receive 1099s from a majority of your customers or clients. Then there's all kinds of different 1099 forms as well. So if you accept credit card processing through PayPal or Stripe, you'll probably get issued a Form 1099-K, which reports all of your credit card sales in excess of $20,000. And then my other tip would be that most tax preparers don't use Form 1099 to prepare your business tax return. All we do is we compare the total of your 1099s to ensure that you're reporting at least as much income as reported on the total of the 1099s that are received. So that's why this tip is in this list of tax prep tips. So Christine, if you'll go to that next slide, I'll kind of point out the new form. So this is that new Form 1099 NEC, non-employee compensation. Essentially, all that this is that box 1 right there on this form. That is the old box 7 on Form 1099 miscellaneous. So the IRS just basically took that box 7 from the old 1099 miscellaneous and moved it to its own separate form for 1099 NEC. You know, to my best knowledge, it's probably because the IRS is trying to track employees versus independent contractors and do a little more of an analysis there. And I think that's why they're breaking out these forms into separate filings. So Christine, if you'll go to the next slide as well, I'll show you guys the old, this is the new Form 1099 miscellaneous. So you can see box 7 there is no longer where you report non-employee compensation. Big thing I want to point out here, when you're issuing your 1099s this year, if you have to issue 1099s, don't report that on box 3 of the 1099 miscellaneous. Remember this new Form 1099 NEC. Okay. When do you have to issue a 1099? The IRS requires that you issue Forms 1099 to any non-corporate service provider to whom you pay more than $600 in a given year. Okay, so if you're having trouble checking or checking that out, contact the business center, contact your bookkeeper, contact your tax preparer. They can help you, report that with your informational reporting to make sure that you're in compliance. There are some pretty steep penalties for failing to file these forms if you are required to do so. And they've gotten pretty serious about it. Like I said, these are the tattletale documents. So the IRS relies on these pretty heavily to make sure that the majority of the tax base is paying their fair share. And these penalties keep rising. So companies can face penalties of up to $400 or $540 for each 1099 that's filed late to a recipient, plus another $540 for each form that's not filed timely with the IRS. So you have to give a copy of the form to the non-employee that you're paying, contractor, and a copy to the IRS. Okay, that's due by January 31st of 2021.
All right, good morning, thank you. Okay guys, tip number 7, we're gonna go into balance sheets. So your balance sheet is another simple report that you can run from your accounting software program like QuickBooks. The 2 important areas to review on your balance sheet for tax preparation purposes are asset purchases and loan balances. So your assets include things like furniture, computers, vehicles, any other large purchases. And generally speaking, an asset is going to cost at least $500, but lots of tax preparers will say they need to cost at least $2,500. And it's expected to be in use more than 1 year. So assets must be depreciated, meaning the full purchase price of the asset is not usually deducted as a business expense in that year the asset is purchased. So your tax preparer can actually run the depreciation schedule, but they're going to need to know when the asset was purchased and what was included in the purchase price. So pulling those receipts is going to be important. And this is going to help them determine how much depreciation can be recorded in the tax year. So your preparer may also want to retain a copy of the receipt or other purchase documentation in their work papers. So just make sure you have that prepared. Now, lots of small business owners record the entire amount of their loan payments as a decrease in the liability owed. Now, not only does this cause the loan balance to be reflected incorrectly, right, on the balance sheet, but it also doesn't separate out the interest paid. And loan payments against the principal are not tax deductible, but the interest on the loan is. So review your loan statements as part of your year-end review with your bookkeeper or accountant or tax preparer and make sure that the loan balances on your balance sheet match the balances on your statements. And as is the case with bank and credit card statements, many tax preparers are going to want to review your loan statements before preparing the tax return. So be sure to include those in the paperwork that you take with you, to your tax appointment. All right, tip number 8. Now, this may seem obvious, but believe it or not, sometimes people forget that they made an estimated tax payment earlier in the year, and it's not recorded in their business accounting because it came maybe from their personal account. So this is just a reminder to everybody that your tax preparer needs to know if you made an estimated tax payment to the IRS so that they can deduct that amount from what you may owe the IRS for the tax year. And so hopefully you would catch this type of thing when you're reviewing your personal expenses and your business expenses and going through that reconciliation process, but just a quick tip. All right, so before we launch into filing and paying taxes on time, I'm going to launch another poll and see how you're feeling for this tax year. So I just want you to select the statement that rings true to you. I will file and pay 2020 taxes on or before the deadline, or I will pay 2020 taxes by the deadline, but file an extension. What is your thought right now? What's your plan? Give you guys a couple more seconds to respond. Good job. And we'll share this out. So looks like about the 80-20 rule. We've got 80% saying we're going to file on time and pay on time, and about almost 20% saying the opposite. All right, so if you owe money to the IRS that you can't pay, then you're probably pretty nervous with the tax deadline approaching. But while you may be tempted to skip filing your taxes and hope the IRS doesn't notice you owe a money, of course, we know that's a really bad idea. So not only will the IRS likely fine you, but you're going to face a much harsher penalty for not filing your tax returns than you'd face for not paying the amount you owe. So my recommendation is if you owe money to the IRS, you need to file your tax return and pay, hopefully, what you owe by April 15th of 2021 for the 2020 tax year. Now, if you, for some reason, can't file by the deadline, you can request an extension. But I want you to remember that the extension doesn't prevent you from having to pay what you owe by the deadline. So if you get a filing extension, but you don't pay your tax bill by April 15th, you're still going to face late payment penalties in most cases. So penalties for failing to file your taxes and paying your taxes late are both charged in addition to any interest you owe on your unpaid tax balance. So filing your taxes on time, even if you can't pay what you owe, is just one of several steps you can take to try and keep your IRS penalties to a minimum. And you may want to consider whether you could potentially take a personal loan to pay what you owe, depending on whether the loan rate is lower than the penalties and interest the IRS is going to charge you. So you can explore an IRS payment plan that can reduce the penalties that you're subjected to as well. So finally, to make sure you don't face the same problem next year, make a plan to save for taxes throughout the year or adjust your withholdings so enough money is taken out of your paychecks to pay the IRS what you owe. If you take an owner's draw from your business, then you want to adjust the amount to include projected taxes and then set that money aside in the savings account or in a separate category for future taxes, or so you can make an estimated payment to the IRS. Derek, do you want to add anything to this?
Yeah, I think one of the things I see most common when I'm preparing taxes is this sort of paralysis from taxpayers, right? You get to the point where you're nervous about what you owe, or you know you owe and you can't afford it. So some tax preparers just go into this paralysis mode and don't take any action. Just like Christine was saying, it's super important that you still file a return, even if you can't afford to pay the balance you owe. That'll at least minimize the amount of penalties and interest you will pay. I also recommend paying as much as you can. If it's not the full balance, pay as much as you possibly can. And then the IRS is pretty, I say this hesitantly, but the IRS is fairly easy to work with when it comes to setting up payment plans. So if you can't afford to pay the entire balance, you can reach out to the IRS and you can set up a payment plan to get back in compliance. And again, that's the best scenario because then you're avoiding all of these unnecessary penalties and interest that accrue from that paralysis and not taking action.
All right, terrific. Okay, and number 10, I want you to think about when it's time to ask for help. So delaying your financial reviews, are just going to cost you more money and time later. So it's important to understand what your own personal limitations are. So if accounting and bookkeeping is not your best skill, it's okay, right? The most important thing is that you ask for help when you need it and you do it sooner than later. So lots of tax preparers create client organizers to help ensure that their clients are fully prepared for their tax appointments. Asking for a client organizer early or other guidance from your tax preparer can also prevent a lot of headaches as you get ready for that tax appointment. And so schedule some time to review the previous year's books with your bookkeeper or your business counselor and make sure any questions that you have already been resolved. And really being comfortable with your books before your tax appointment is going to make the process go a lot smoother for both you and your tax preparer. So again, I just want to launch a final poll today so that you come away with a little bit of an action plan. And I just want to know what statement best describes you today, right? I feel confident, prepared, and ready for taxes. I think I can gather the information at this point for a tax preparer, or I'm feeling pretty overwhelmed right now and I think I need to ask for help. Okay, which bucket are you in? There's no wrong answer here. I'm just trying to get you to kind of self-assess where you're at so that you know what your next step is. So let's take a look how everybody is doing. And we'll share this out because no one is alone, no matter what bucket you're in. Okay. We've got lots of people on the call today, and it looks pretty evenly split. We've got 32% that are feeling confident, 47% are thinking that they can gather all this information, and we've got a little over 20% that really need to ask for help. So if you're in that bucket, please reach out to us at the Women's Business Center, or reach out to an advisor that you have in your life, and don't delay, don't put it off. Derek, any closing thoughts or words for us?
I would just say my only other piece is be prepared to give as much information to your tax preparer as you can. It's hard for us to give you the best advice if we feel like you're withholding information from us or if you're hesitant to talk to us about it. So, work with a tax preparer that you really trust and feel comfortable sharing all of the information necessary so that we can give you the best possible advice.
Absolutely. Transparency is always really important, and you don't have to feel embarrassed about where you're at with your finances. There's a reason that all of these people are in business doing this, and it's because they're experts in their field and you're an expert in your particular field. So I always tell my clients, for whatever their expertise is, I wouldn't feel comfortable trying to do what they do, just like they're not comfortable doing what I do. So that's okay. We all have unique talents and gifts, and if you need to ask for help, that's a good thing. That means that you're strong enough to realize when you're in over your head. All right, guys, any questions for us today before we close out? I'm trying to be respectful of everybody's lunch hour. And so it looks like I've got a quick one here, Derek. If receiving online payments for services that this business provides via PayPal, is it a requirement to use a business account?
Oh, that's a good question. So it's not technically a requirement to have a business account. However, the IRS, when you run business and personal together in the same account, the IRS calls this commingling funds. And they're not super keen on this commingling of funds. Basically, it makes the burden of proof on your expenses much more difficult, right? Because the IRS agent that's investigating would have a harder time, breaking out business versus personal expenses and believing you on that justification. So I always recommend having a separate account for business. So if you do have a PayPal account and you're transferring funds out of your PayPal account to your business account, that's great. I really like to see clients that have a separate PayPal account specific for their business, separate from their personal one.
All right, terrific, good feedback. Okay, everybody. So we just want to thank our funding partners. The Women's Business Center is made possible through several partnership agencies. The Small Business Administration and the Wyoming Business Council are our primary funding agencies. And so, of course, we're thankful for their support. If you'd like contact information for the Women's Business Center, you can always go online to our website at wyomingwomen.org, or look for our phone numbers and direct email addresses right here. Mine is in the lower right-hand corner. And so when we log off today, I'm going to ask everybody to just stay on for another 2 minutes and complete our survey. This information really is valuable to us, and it helps us do our programming and planning for months to come. So thanks, everybody. Thanks, Derek, for joining us today, and happy holidays.
Thanks, guys. Happy holidays.
Bye-bye.